All right, guys, and welcome to chapter 16. This is going to be real estate appraisals, okay? Now, when it comes to appraisals, let's start with the very basic foundational question. What is an appraisal? Okay, so an appraisal, all it simply is in layman's terms, is the estimation of value of a property in this case, meaning we are determining how much the property is worth, okay? Now, when it comes to appraisals, appraisal is not a science, it is an art, meaning that there is no exact way to ever determine the exact value of a property. That doesn't exist. Now, the person that is highest qualified to provide an appraisal or the estimation of value is obviously the appraiser, because they've gone through the most extensive training and they have the certification to give the best opinion. But we could still appeal when an appraiser gives out the appraisal report and we look at it and we see the comparables they use. We can now appeal it and in many cases get that price adjusted. So understanding that, you got to know that ultimately it is an opinion. Because let me ask you, what is the actual and true value of a property? Could you maybe guess what do you think the true value of a property? Because like I just told you, an appraiser or the appraisal report can be modified. Now the banks, since that is the most qualified individual, will accept those reports or the appraiser's report as true value. But it doesn't necessarily mean that is the actual value. They'll accept it because there's nobody more trained to give that value, but we can appeal it and that kind of stuff. So going back, what is the actual true value of a property? So the true value of a property is what somebody's willing to pay for it. So if an appraiser gives you a value and nobody wants to buy that property at that price, is it really worth that? Absolutely not. Because even if, let's say, I have my phone right here and I want to give my phone for $10 and it's a brand new phone, gifting it, and nobody wants to buy it, is it really worth 10 bucks? No, because nobody wants to buy it at that price. So people's willingness to purchase or pay for something is the true value of a property. Okay, so let's go ahead and look at the terms. First, we have AQB, or Appraiser's Qualification Board, and then we have ASB, Appraiser Standards Board. Now, these boards have a particular role. Now, the Qualification Board, what they do is they essentially make sure they keep the standards for the qualifications of appraisers, meaning education, requirements, rules, bylaws, things like that. While the Appraiser Standards Board keeps a metric or a standard of practice, meaning what they have to make sure that to what standard are they going to have to now provide information, the reports, etc., etc., etc. Okay? Next, we have a federally related transaction. That is a real estate transaction that a federal institution is requesting, pretty much. Now, the true definition is going to be the federally related transaction is a real estate transaction involving sales, lease, purchase, investments, or exchange in real property, or the refinancing of real property, or the use of real property as security for a loan, and the appraisal is being performed for a federally financial regulatory agency. Now, that is the actual definition. But again, in its basic form is, some sort of analysis or some sort of deal that involves real estate for a bank or an institution or federally related institution. Okay? So next we have Uniform Standards of Professional Appraisers Practice, or USPAP. Okay? So USPAP is the standards for evaluating real property, meaning they set the guidelines of what the appraisers have to do it as, or how they need to present their stuff. So it all kind of works together, because USPAP is kind of like the organization that also kind of governs the first two terms, the AQB and ASB. So you want to look at it as kind of like when we saw FREC and have the division of real estate that kind of helps with clerical work, but it's not the main organization, something along those lines. Okay? You don't have to hone down so much on those particular terms because although they're here, it's just mainly so you understand in case they pop up as answer choices, but you're really not going to get too tested too much on that because there's other things that are more important. Okay? So next we're going to look at a CMA or comparative market analysis and a BPO or a broker price opinion. Now, these methods are what we agents use more often, specifically speaking the CMA. The BPO or broker price opinion, that's mainly done by brokers. I mean, some agents could do it, but ultimately, the difference is a CMA or comparative market analysis. Look at the name, comparative market analysis. What we do is we analyze the market, specifically sold properties within the area of the one we need to find the value, and the closer to today, obviously, the more accurate our price is going to be. So ultimately, the CMA, what we're looking to, most of the time, we'll have a range where we have an higher or upper range and a lower end range. Now, depending on the condition of the property, when we go look at it, if we're like, let's say, trying to help a seller out or somebody that wants to sell their property, now, once we actually step foot in the property, we're going to be able to see the condition. Once we see the condition, then I'll know, oh man, it's got all the upgrades, they keep it real nice, they maintain it, it's got this, it's got that. Now I can start sliding it into the upper end of my parameters or my range. Same vice versa, if the property is not upgraded, it's beat up, and it's TLC or tender love and care, as we say it in the industry, or there's a lot of repairs that it needs, then I'm going to put it on the lower end because again, it needs a lot of work. Okay, so that's more or less the CMA. Now the BPO is a little different because the BPO tends to be more of an exact price. That is usually, a BPO will be requested by banks whenever they're doing, let's say, foreclosures, short sales, there's sometimes relocations. In those scenarios, the bank wants more of an exact price because it's kind of like starting the foreclosure process. The bank wants to know more or less how much a home is worth. So then they have a starting base for negotiation, and then they can kind of work with the attorneys and the auction and see how much they can recoup, knowing more or less how much the property is worth. But it doesn't guarantee them that price, because at that point, if we're going foreclosure, obviously it's going to be sold in an auction. They might not get exactly what the property is worth, but at least it serves as a guideline, okay? So keep that in mind. Now we're going to look at the concept of value. Now, value in itself has three concepts that a lot of us tend to use, myself included, in regular terms and regular conversation, that although we are able to understand each other based on the context that we are speaking, for the sake of the exam, these terms are very, very specific, and you have to know how they're going to use them in the exam so you don't get them mixed up and now get questions wrong. So those are going to be cost, price, and value. Now, a lot of the times we could go out there and say, hey, how much did that cost you? Well, in the sake of the exam, we're asking how much it cost you to build. In my context, I asked what was the price, how much you paid for it, meaning how much did it cost you when you paid it. But for the sake of the exam, cost means the construction, how much it cost you to construct. Because think about it. When it comes to properties, I could build a property for $200,000, sell it for $230,000, and the property be worth $260,000. Meaning the value of it is $260,000, the price is $230,000, but it cost me $200,000 to build. So you need to make sure that you can differentiate that, because when we say cost, it means the replacement cost or the cost to rebuild it is new. Where price means how much you actually paid for it or how much you're charging for it. And then the value, of course, is how much it's actually worth. So rely on the example that I just gave you. If you need to rewind, go ahead and make sure you understand these concepts, because they are important and you will be tested on those. Okay? So next we're going to look at the types of value, because value have different types. Depending on the type, you're going to know what's what. For example, the first one is going to be assessed value. Every single time you see the term assessed value, it will always 100% without exception deal with property taxes. Because the person that does your numbers and figures out your property taxes is called the tax assessor. Okay, that's their title. So therefore, an assessment would be your property taxes. Therefore, assessed value specifically and will always deal with property taxes. So anytime in the exam you see assessed value, instantly you have to know without exception it deals with property taxes. Okay? So that's what we kind of go by, assessed value. Then you're going to have insurance value. Now, insurance value would be the equivalent of the value that you could get through an insurance company. So if, let's say, you needed to make a claim, well, whatever that insurance ends up giving you for whatever the claim is, that is the insurance value. Same thing with real estate, okay? Then you're going to have investment value. Now, investment value is one of those terms that is relative. Because, for example, if you're an investor and I'm an investor, now, one deal could be beneficial for me, and meaning it works for my numbers and my purposes, but not for you. Because, for example, if let's say I want 14% return on my investment and you're looking for 10 and the deal we're evaluating is at 12%, well, it will work for your purposes because you're getting 12 and you want 10, but it won't work for me because I want 14 and I'm getting 12. So that investment value will not be worth it for me, while it will be worth it for you. So that's why it's relative to the investor. Okay. Next, we're going to have liquidation value. Now, liquidation value would be, for example, for foreclosures or that kind of like tax deed sales and things like that, where essentially you're just figuring out what the value would be if you needed to liquidate it in a rapid sale. What can I recoup from it? And, if I liquidate it quickly. Obviously, you're not going to get market value because otherwise you're going to have to wait longer. This is for a quick sale. So like foreclosures and things like that. Next, you're going to have going concern value. Going concern value specifically deals with income producing properties, meaning a rental, a business that produces cash flow, or anything in general that gives you monthly cash flow or monthly income. That is specifically dealing with going concern. Now, the way I kind of remembered it was going concern was, since the property produces income, I'm always going to have a concern or a going concern to make sure that my output, I can maximize my earning since I am putting or receiving monthly cash flow. Okay, so make sure you know that. And next to last, we have salvage value. Salvage value would be whatever you can recoup after whatever the item has done depreciating. So for example, think about an old vehicle, an old car. Regardless of the model, regardless of the make, once it reaches a certain age or a certain condition, it's just now not really worth anything aside from maybe what the junkyard could give you, which is like $350, $400, $500. Something like that, regardless of the make and model, because it's done depreciating. That would be its salvage value. If I had to salvage, what would be whatever I could get for it? So you want to think about it that way. And then lastly is going to be market value. That would be the most competitive price in a competitive market, meaning what is the highest that I could give it based on the market that we're currently in. Now, obviously, market value, you're already at the top for the most part, so it takes longer to sell, as opposed to maybe like liquidation or salvage value. Okay, so those are going to be your types of values. Next, we're going to look at the characteristics of value, meaning what are the items that can influence the value of a property or the value of something. First things first, let's look at number one, demand. Demand is a huge determinant of value because think about it in its very simple logical form. If I have a property and everybody wants it, it's in high demand, what do you think is going to happen to the value or how much I could charge for that property? It's going to go up, because now if you don't want it, he wants it and she wants it, and now I can get a bidding war and get the price up. Same the opposite. If nobody wants my property, now the value has to go down so I can get interested people, And now we can actually get a business going, but the value would have to go down because I don't have enough demand. Next is going to be utility, meaning how useful something is. The more useful an item or a property or something is, the more value is going to have. For example, if you have a property that could be, let's say, used as a business and used as a residential rental per se, that is going to now have more value because you can use it as a business rather than just a residential property. So it's got more utility and it's going to be worth more. Next, you have scarcity. Scarcity means and essentially deals with how rare or how, scarce something is. For example, what does everybody want? What they cannot get. So if there's something that everybody wants but is very rare to find it, obviously the price would go up because there's not so many readily available. And then the last one is going to be transferability, meaning how likely or how easy it is to transfer the ownership to somebody else and they could pay you for it. Because look at it this way. If I have this, this building or, let's say this is a property, this phone. Now, if I want to sell it, but I don't have the means to sell it or can't sell it, then how much is it really worth if I can't even sell it to somebody that wants to buy it? So in that scenario, you got to be careful when it comes to transferability because, for example, condemned properties, those lose a lot of value because they're condemned. They're going to get thrown, they're going to get destroyed. Some people, sometimes they don't do their due diligence correct and end up buying condemned properties. And then once they realize that they're condemned, the value is going to tank because it's condemned. Can't really do nothing with it. Okay? So those are going to be, again, your characteristics of value or the 4 items that are going to determine if value goes up and down. Demand, utility, scarcity, and transferability. Okay? So next we're going to look at the principle of substitution. Now this is the most important term when it comes to appraising. Why do you think that is? Why do you think the principle of substitution is one of the most important terms in appraising? Well, the answer is that is the whole gist of appraising. Meaning, if I'm looking for the value of something, I must find a close substitute to see how much that substitute is being sold for. Because if mine is just like it, and this one is being sold for, let's say, $30, then whatever my item is also worth $30. So you always find substitutes to compare them based on how close they are, and then you determine the value of whatever you're trying to figure out. In our case, real estate properties or real properties. Okay? Next, we have highest and best use. Now, highest and best use is literally the appraiser's sole goal in an appraisal. Meaning, their job is to give a property its highest and best use because that gives it its highest value. Meaning, let's just imagine there is an imaginary line around me that defines my property. Okay, that's my property line. Just imagine it's there. Now, as an investor or somebody that owns a property, what would be the highest possible value this property could have? What could I put in here that could increase the value as much as it could? Now, like I stated earlier, it would be a business. Something that generates income on a consistent basis would be the highest possible value. But what if the property is zoned for residential only? And now I cannot use it as a business. Now, is it the same space? Yes, but its use now varies. And depending on zoning and many different aspects, you can use certain properties for one thing versus another. Now, depending on that use, that is going to determine the value. Because like I said, if I have this property and I could put a business on it, my use will be commercial, meaning I'm generating income. Versus, let's say, a residential property where sure, I could make maybe a little bit of income renting the property, but I'm not going to make as much as a business that actually sells products and has ongoing sales. So that is where now, based on the rules, zoning, many things, the appraiser will come in and give a property its highest and best use, which means that based on that, it will give it the highest possible value. Okay? So again, if you didn't understand that concept, rewind it real quick, check it out, because it will be needed. Those are the two most important concepts in appraising: the principle of substitution and the principle of the highest and best use, which is again the sole goal of an appraiser, to give a property its highest and best use, because that gives it its highest value. Okay? Next, we're going to look at the term over improvement. Now, over improvement is a term that unfortunately can happen commonly to customers or homeowners, because a lot of the times people, over improvement is investing too much into the property that you're not going to be able to get back out when you sell it. For example, what is one of the biggest over improvements in the entire country right now is going to be swimming pools. If you put a swimming pool in your home, right before you sell it, you will lose money. There's no absolute way that you can invest in a pool and get it back out on the sale. That will not happen. A pool can cost anywhere from like 60, 70, all the way to like $100,000 plus if you build it with an enclosure and all the bells and whistles. And an appraiser, the max that they'll give you for a pool when it comes to value will probably be somewhere in the range of like $15,000 to like $25,000. So you invested $100 to get only $25,000 in value, not worth it. So if you're a seller, never, ever, ever put a pool in right before you sell, because that is an over improvement, and you will lose money because you will not be able to get that money back out. So I mean, if you're putting in a pool, enjoy the crap out of it, because you're not gonna get it out in value. It's more for enjoyment, for your family, for your kids, that kind of scenario. But again, to each their own. All right, so that's gonna be over improvement. Next, we have assemblage and plottage. Put these two terms together and batch them in your head. Because first, assemblage specifically deals with combining lots that are into a bigger parcel. And plottage would be the added value as a result of having a bigger piece of land. For example, imagine if you have two quarter acres, 0.25 and 0.25 right next to each other. Or let's just say half an acre and half an acre. And you decide to combine them. And let's say now each quarter acre is selling for $25,000. So if let's say you sell both quarter acres, you're going to now make $50,000. $25,000 from the one quarter acre and $25,000 from the other. But now if you combine them, let's say half an acres are going for $60,000 or $65,000. Now by combining them, since you have half an acre, now you could sell it for more than each individual quarter acre. So in this case, your plottage would be the extra $10,000 or $15,000 you would make by combining or assembling your two lots. So again, assemblage is combining them, and the plottage would be any added value that you would get by having a bigger piece of land. Okay? So next we're going to look at progression and regression. So now, depending on the surrounding environment of a property, it can increase or lower its value. So let's look at the names. Progression would be per se when the surrounding area is getting brand new properties, or people are remodeling their properties and everything is starting to look nice. So now what happens is your property goes up in value because everybody around you also has really nice properties, so the area goes up. So your property progresses in value because your surrounding area is also progressing. And then in the same token, we have regression. Let's say you have a pretty nice home in a really crappy neighborhood. Well, if that's the case, then your property value is going to go down, or it's not going to be worth what it could because of the surrounding area. So ultimately, we've been at property sometimes in the past where we look at customers and we're like, oh my God, if I could only take this building, pick it up and put it in a different lot somewhere else, your house will be worth at least $100,000 more. But because it's located in here, it's worth so much less, unfortunately. And that is what kind of comes with the whole progression and regression. That's why, for example, HOAs, homeowners associations, they force you to keep everything standard, meaning the grass can't get too tall, you got to paint certain things, because they want to maintain those property values, and they're not going to allow you to not take care of your property, and then the neighborhood starts to lose value and starts regressing. That they'll start fining you before that happens. That is kind of the sole purpose of an HOA, or at least the main purpose, to maintain property values. Okay, so those are going to be the two terms that you're going to need to know when it comes to that. Okay, so now we're going to jump into the three different approaches, or the three different ways that we have to learn how to evaluate or estimate the value of a property. In this case, do the appraisal method. So there's going to be three methods we're going to look at. First is going to be your sales comparison approach, or comparable sales approach. Now listen to the name, sales comparison approach, meaning we're comparing previous sales around the area. Now what you need to understand is that this method is specifically used for a lot of residential properties, because there's plenty of inventory that have sold around that now we can use as comparison or comparables to be able to determine the value of a property. Okay, so that's going to be method number one. Method number two is going to be called the cost approach. Okay, so, or what I call the cost depreciation approach, meaning this method is used for when buildings are weird types of buildings or specific things that you don't have a lot of comparison or a lot of sales around. For example, this is going to be for airports, for hospitals, for those types of buildings, because think about it. When was the last time a hospital sold in the area? Or when was the last time an airport sold in the area? We're really not going to be able to determine that, because those types of things are not like residential properties. But what the cost depreciation approach looks at is how much would this building cost to build from scratch. Then I go ahead and remove the depreciation, and now that leaves me with the value of the building. So instead of using comparables or comparisons of sold properties, we look at its construction and its depreciation to determine the value. Now, the appraisers will do all the multiple methods all at once in their appraisal report, so that way, and they'll use the most accurate depending on whatever the property is. But ultimately, again, the cost depreciation approach is specifically used based on construction minus depreciation to be able to determine the value, because we don't have that many sales. Again, this is for hospitals, airports, things like that. So that's going to be method number two. So method number three is going to be what we call the income approach. Now, the income approach is used for income producing properties. So that actually, guys, that is one method that us investors, we use on a regular basis. Every time I'm evaluating a complex, 8 units, 16 units and up, I'm going to use the income approach, because I need to know if the income approach bases the value of a property not so much on the property itself or the construction, but on what it can generate, meaning how much income it brings in, because it's got to be an income producing property to use the income approach. Now, the income approach could be used for anything, but for the sake of the exam, you got to know it's strictly only used for rental properties, rentals. Now, obviously, if I own a restaurant or have a manufacturing company, I'm going to use the income approach to determine the value, because I got to base it on income and on sales. But we're not going to get tested on all that crazy stuff on the exam. All they're going to test us on is Ricky has a building that he charges $1,000 a month, and then it takes it from there. Or he has a 4-unit building where he charges $1,000 per unit. And now we can use that income to build, what we have to do. And we're going to go over the approach a little bit later. But just know that it's strictly for income producing properties. Now, in our case for the exam, it's strictly rentals. Anything else will not apply. Even though we already know in the real world, we will use it for many different things. And this is something that if, let's say, you're thinking of investing in the future, this would be something you have to know, because all investors have to use this approach. We use it in the real world. The other ones, we do not. Okay? At least not the exact way that the appraiser uses it. We have our CMAs and things that we use. Okay? So now, what we're going to do is these approaches, we're going to be taking them one by one. So go ahead and as you start going through them, if you need to, once we start going through them, if you need to review or stop it, rewind it, take your time, make sure you learn the methodology, because the way I teach it to you is going to be different than your textbook if you have one, or I teach you the very logical and simple way, or I try to. So when we go over it, stick to what I'm teaching you. And if you got a book, try not to get too involved in the book and learning how I'm teaching you, because that's how they'll test it on the exam. Okay? So the last thing we're going to cover, okay, so now time out. This would be where now all the other videos come in, because now I have 3 approaches to make. And now I'm going to provide you each and every little video so you can splice it in.
Yeah, okay, so you're going to give me those and I'll just put those in.
So what I'm going to do is, so this is just your prompt for this particular video.
Right.
The previous videos were going to be all the, the actual stuff on my iPad.
Right.
So this is going to be only a last little part, because I have one last part of this chapter.
Go ahead.
Okay? So, and the last thing we're going to be covering is going to be your CMA, or your comparative market analysis. Now, like I mentioned, CMA, you want to use recently sold properties, meaning the closer we can make or find comparable sales to today, the better is going to be, or more accurate our price will be, because the market was different 6 months ago and way different a year ago. So the closer to today, the more accurate of a price we're going to get, or value we're going to find. Also, currently on the market, we want to evaluate what is also available on the market, because that will be our competition. So when we're out with our customers and our sellers, we want to be able to have this information, because if the seller wants to put a price on a property that's too high, and all of a sudden we already see that the neighbor down the street has a bigger home, nicer home for cheaper, do you really believe we're going to sell? No, that's our competition. We have to price our properties accordingly. Even though our CMA might say one thing, we got to play the market. We don't just make up numbers, you know what I mean? And that's sometimes the issue with sellers. They want a specific price, but we don't go on hopes and wants. We go on data. We go on these statistics or on these figures, because that is, that's why we use comparables and we use sold properties. And then lastly, recently expired listings. Because if we can evaluate what listings expired, we can know at what price range we can't be at, because otherwise we will expire or not sell as well. And what I mean by expired, I mean we left it in the market for however the contract was for, and then nobody bought it because it was either overpriced or nobody wanted it. So when we're dealing with CMAs, we always, along with what we already discussed, that we want to find properties nearby, properties that kind of look like ours, and properties like recently sold. You also want to keep in mind properties that are on the market, because again, that is our competition. And then recently expired listings, because that'll give us a threshold where we cannot be, because otherwise we're not going to sell. Okay, guys? So that is going to conclude chapter 16. Now, there's going to be, it's a big one, there's going to be 8 questions from the state exam coming from here. A few are going to be math, obviously, because we had the 3 approaches that we discussed. Make sure to go back to those, review those. Same thing with your gross rent multiplier and gross income multiplier, because those I don't have a trick for, like I do the other ones. You're just gonna have to memorize very simple equations, but there will be at least one question in your exam on GRM or GIM. So definitely go over it, rewind if you need to, go back, check it out, do your examples, but take your time. All right, guys? So again, that's gonna conclude on chapter 16. There are 8 questions, and I'll see you on the next chapter. All right, see you then.